If you operate a business or manage a community association in Florida, the state levies an ad valorem tax on your physical, movable assets. That means every desk, computer, and chair used to run your operation is subject to the tangible personal property tax. But there is a built-in protection. The state provides an exemption that makes the first $25,000 of your property's assessed value entirely tax-free. You just have to follow the specific filing protocol to claim it. Missing the initial filing deadline means you forfeit that exemption for the year. The county will tax you on the full assessed value of your property and add late penalties to the final bill. Today, we are going to complete Form DR-405 together. By the end, you'll have a perfectly executed return, legally securing your $25,000 exemption, setting you up for a permanent filing waiver. Step 1 happens before you even look at the tax form. You need to conduct a physical walkthrough of your office, clubhouse, or pool deck and log every unattached physical item. There are exactly 3 categories of assets you must exclude from this list. Do not count any inventory you intend to sell, the physical land your building sits on, or any registered road vehicles like cars and trucks. Take your master list of logged inventory and sort the items into distinct groups based solely on the calendar year you bought them. Create one group for 2023 purchases, another for 2024, and so on. Grouping your assets by the year of purchase is a mandatory requirement. The county property appraiser relies on these specific year groupings to calculate the final assessed value. With your inventory sorted, you now assign a dollar value to each item. Florida law requires you to use a very specific standard for this, the original installed cost. To calculate original installed cost, take the money paid when brand new, then add sales tax, shipping costs, and installation fees. If a receipt is lost, swap in the current retail price of an equivalent brand new version as your baseline estimate. Avoid the temptation to look up what your used furniture is currently worth on resale websites. You also cannot use the deeply depreciated numbers listed on your federal income tax returns. Reporting 100% of the original installed cost ensures your return complies with state law, which protects your business from valuation audits and immediate rejection by the county. Now we open Form DR-405. Start at the top of page 1 by filling out the basic identification boxes. Enter your official taxpayer name, the property location, the exact date your business started, and your business type. You must also locate your tangible personal property account number. This is typically a 6 to 8-digit number found on the mailer the county sent you. Enter it clearly in the designated box. Just below the header, you will see Schedule 1 and Schedule 2. Schedule 1 is where you report equipment you lease from third parties, like a commercial copier. Schedule 2 is for equipment you own but rent out to others. If you do not lease equipment or rent it out, you must physically write the word none or NA across these schedules. Explicitly marking empty schedules prevents the county appraiser from rejecting your form under the assumption you simply skipped a section. Move to page 2 to the main asset schedule. This is where your year-by-year inventory groups are recorded. For each purchase year, fill out a new row with a description, quantity, and the exact original installed cost you calculated earlier. Do not perform any depreciation math yourself. The county uses its own official indices to determine the final assessed value. Next, locate the supplies box. Florida requires you to report the average dollar value of consumable supplies you keep on hand, like office paper, pool chlorine, or cleaning products. For a typical small office or community clubhouse, a standard estimate of what sits in your supply closet is usually between $200 and $500. By supplying only your raw inventory costs and supply estimates, you complete your side of the ledger and leave the complex depreciation calculations entirely to the county. To finalize your return, drop to the bottom of page 1. Sign your name, date it, and write your official title. Submitting an unsigned form triggers an automatic rejection. Once signed, you must submit the form to your county property appraiser. The absolute legal deadline for this filing is April 1st. Filing on time triggers the waiver rule. After the county verifies your total depreciated asset value is under the $25,000 threshold, they will mail you a postcard officially waiving your requirement to file this form in future years. If you buy new equipment in a later year and your total asset value crosses back over $25,000, your waiver is automatically voided and you must file a new DR-405. As long as you stay under the threshold, maintaining this waiver transforms an annual tax filing into a single one-time administrative step. You now have a complete and accurate DR-405. Your assets are grouped properly, valued at their original installed cost, and reported without any unauthorized depreciation adjustments. Make a photocopy of the signed document for your internal records, then mail the original or upload it directly through your county appraiser's web portal. Executing this form precisely protects your organization from arbitrary tax assessments. It creates a clean record with the county and safely locks in your $25,000 exemption.